Morning, I'm Chris Beach, and welcome to Chart the Markets on IG Live. And it's a slow start to the day for most indices and indeed most markets after the volatility of last week and the strong gains we saw in stocks yesterday. Earnings season is back with us from today with Goldman Sachs and a number of other major companies reporting earnings. And that marks, if you like, the real start of the season. We had the warm-up on Friday with JP Morgan and other banks releasing earnings. We had Monday off, as seems to be traditional in US earnings season. I don't know quite what it is about Mondays, but there we are. And we're back with it today. And from today onwards, the first two and a half weeks of earnings season is the busy time. We get the banks, we get tech stocks, we get oil companies, all coming through thick and fast. So expect that to dominate the news as much as it could in a period when we're still worrying about heightened tensions and, of course, conflict in the Middle East and potential impact on oil and other global markets. Markets have really shrugged off, I think, last week's inflation data from the US. There was a bit of a spook around Wednesday's PPI and Thursday's CPI, which showed a rise, an acceleration in price growth in the US. But they've certainly put that behind them, I think. And at the moment, pricing still points to only a 30% chance of a Fed rate hike by the end of the year. So either in November or December, only a 10% chance, I think, as of yesterday, as according to market pricing, for a November move. So I think the Fed's comments about setting the bar very high for any future hikes has certainly done the trick at the moment. So not too much in the way of movement so far this morning in global markets. We did obviously have UK data this morning for the first time in 2 years, really. I think UK wages have outpaced inflation. So that's good news in one sense for UK consumers, but we know, of course, inflation still remains relatively high. And there are signs maybe that the labour market in the UK is really beginning to decisively slow down. So that's also something to bear in mind. So start with indices as normal, beginning with the Dow, this time currently trading at 33,935 and back above the 200-day moving average. Once again, we closed above it yesterday. That is in some ways viewed as a catalyst, although the sharp-eyed among you will know that we closed above it on Wednesday last week and then we dropped back. But I think that was the volatility was down to the CPI figure really last week. The index still clawing its way higher is probably the best way to describe it. It's certainly after the initial bounce last week, it certainly has seen some of the gains or certainly choppier trading result. But we are above the 200-day moving average, so you can put that in the box for a more bullish view in the column. And really that takes us on now towards the area where you can see the 50 and the 100-day moving averages, and then beyond that you've got trendline resistance from the late July highs for the Dow. So you could see it rally all the way back to this kind of area, maybe 34,400, and then we'll see whether it falls. And certainly that'll be definitely something to watch as we get there. I'm not saying it will repeat what we had in September, where we hit the trend line and then slumped, but that's definitely something to keep an eye on. Really, that maybe the index struggles from there. But we are into Q4 and we're getting towards the second half of October, which is usually a positive one for stock markets. So seasonality appears to be with the Dow for the time being. And that's our initial target in any upside. But that's about another 600 points or so for the Dow, is that trend line resistance. And once it gets there, we'll see what it does next, essentially. Our view will be determined really by that. But not a bad performance for the Dow, really recouping Thursday and Friday's losses on Monday. So putting it back above, as I say, the 200-day is always a good sign for those expecting it to continue to rally. Going over to Japan, and the Nikkei also still firmly off its lows from the beginning of October, where we bounced off the 200-day moving average. That's always an interesting sign when the market treats the 200 days at the support level. Certainly the buyers coming in there. And yesterday as well, while the Nikkei dropped in the Japanese cash session, if you like, at the very beginning of the night, beginning of the week, overnight for European traders, it then rallied along with other global markets yesterday afternoon. Not too much follow through for the time being, just stalling around the 50-day moving average. That's a slightly worrying sign, I suppose, for some investors. Maybe it just says that some of the bullish momentum we saw in a week is fading. This is the hourly chart. You can see that there. But of course, you need to remember that we went from the low down at 32.58 on the 4th of October, and then we gained 7% in the space of just under a week. So it wasn't surprising that the pullback, when it came, was fairly dramatic, 3%. That's what you tend to see. And now the buyers seem to have recouped control here. You've had a higher low, created a really solid higher low, and then a move back above 32,200 clears the way in the short term, at least, for further bullish movements. Again, it's a question of targeting trendline resistance, this time from June highs that could take us on back towards 33,000. But the buyers do appear to be back in control here after setting the index higher from 31,500 yesterday. So we need to be back below that to suggest this downward move is continuing. And then jumping back this way towards France, European indices, of course, have had it really tough over the past couple of months. That's really a symptom of, as I say, the big gains from earlier in the year. Really strong performance into March and April, and then quite disappointing since then. So I think people looking for continuation of the trend in European markets really have been disappointed. Luxury stocks also last week, a big component of the CAC not doing particularly well. But it has held above 7,000. I think that's an interesting sign there. The fact that it has stopped going down, as ever, I've always taken the view that markets have three phases. They go up, they go down, and they also have a consolidation period. And you have to move through the consolidation period to get from one to the other. And that's what we're doing perhaps at the moment, that we've stopped going down for the time being. We've found buyers emerging around 7,000 itself in this broad zone of support here. You can see buyers stepping in to defend this one. So you need a close really back below 69.50 or indeed below 69.50 to say, okay, we've broken this kind of box of support and now we're headed back at least to these March lows, maybe even down towards that very precise March low down at 67.77. But for the time being, buyers doing their best to try and stall this one. In the short term, though, they need to get this above 7,200 for us to be a bit more confident that this rally has some legs. And of course, there's a lot of problems that lie ahead for any bullish rally in the CAC. If and when it wants to, then it will have to challenge first, really the 200-day moving average, and then also here trendline resistance from the late July high, the end of July high. That might come into action just close to the 200-day as well. So there's quite a few hurdles for the index to breach to the upside for any sustained rally to take place. Back above 7,300, and maybe we'll have to reassess where we are, and maybe it will then be a more optimistic view. But for the time being, there's a lot of heavy lifting to be done by the bulls to get this one back on an upward footing. FX markets relatively quiet once again. Euro dollar doing its best to try and claw its way higher. Sorry, that's the second time we've used that, but still, that's what we're seeing here after the drubbing it got last week. Unsurprisingly, the euro got hard hit in the wake of that US CPI report, which of course was the second month in a row that prices have risen after a steady downtrend for most of the rest of the year so far. That gave the dollar a bit of a lift after, again, you saw that big move higher for euro dollar towards the beginning of October, then slump. But we seem to have stabilized once more. So it's up now to the buyers now, see if they can break trendline resistance from that high back in July, all the way up at 112.75. That's the key thing. It's a very steep trend line, really, at least if you look at it in this time frame. So it could be that we're just seeing it consolidate. Maybe it pushes back towards the 50, starts to sell off once again. But obviously, with the price below the 200-day and the 50-day moving average falling below the 200-day and continuing to fall, as it did back in September, the broadly negative view, I think, remains in place, and that would have to change dramatically with a long-term move back above 107.60 at least, and then ideally above, again, that 200-day moving average. I always tend to regard it as something as a line in the sand for this. If it's above the 200-day, you broadly tend to expect it to continue rising. If it's below, then you expect it to continue falling. It doesn't always work. It's not a hard and fast rule. There is no hard and fast rule, of course, in markets, apart from risk management. But there it is. That's how we kind of view this. And the fact you've got the 50-day below the 200-day and the 100-day moving average poised to cross over as well does kind of lend weight, I think, to the bearish view for the time being. If we're looking at the pound, again, it's a very, very similar chart all the way through this year. Big rally, pullback, but continued breaking through the 200-day moving average. You've got your death cross finally in cable. You've got the 50-day crossing below the 200-day, which, as I've said before, gets that exciting name of a death cross. Of course, it just reflects the fact you've had this big decline since the end of July. But again, it does really reinforce the view that we're in more of a downtrend here than an uptrend. It's notable that rally at the beginning of October stalled around 123 and then got firmly sold into. It's a tiny bit of a bounce yesterday, along with risk on move across other markets, but certainly looking a bit tougher today. It's a big week for UK data though, so bear that one in mind. UK CPI, UK inflation is tomorrow, so that could maybe move things if you get a slightly stronger reading on UK price growth data. But certainly tough to be too optimistic on this one while it's below 123, and that's notable because that was key support back at the end of May. The pair dropped back towards 123 before it began its next leg higher. It rallied and then faltered at 123 and then has fallen back since then. So clearly an area to watch, really. Not exactly confirming a view one way or the other, but certainly would give credence to the bearish view so long as we remain below 123. And then finally, dollar yen knocking on the door of 150 once more. You can understand the reluctance to push this one higher if we can take that kind of view on markets. Understandably, people are nervous because the Japanese Ministry of Finance has been keen to stress that they're looking at intervention. You had that volatility at the end of September, beginning of October, around the 150 level. And that really is weighing on the pair at this point in time. But it doesn't want to go through 150, but it doesn't show any desire to go much lower. And of course, that's dollar strength really coming into play because we know how strong the US economy is. The Bank of Japan shows no desire to tinker with Japanese monetary policy at all, really, at least not in the immediate future. So I still think we see 150 tested again. I think it continues to move on from there. And definitely, as we're talking about trends, the uptrend is still firmly in place. A rising 50-day, a rising 100-day, a rising 200-day, and the price firmly above all three. So it's really the case that we're looking still to buy into weakness, I think, overall, rather than sell the rallies, because the rallies, rather than sell the rallies, because it's likely that any pullback will be short-lived and that we should see it testing 150. Although, if you're looking at it at the moment, obviously be aware of this potential for heightened volatility. And if you're sitting on it from much lower down, say back in August, A, well done, and B, just be aware that you could get some volatility around this month. Looking at a medium-term view, it really have to go back below 145 to put some sort of real dent in the uptrend. But that's something just to watch if and when it happens. Finally, turning to commodity prices, as ever, gold, a big popular one on the IG platform, on IG clients, is why we cover it every day. Huge week for gold yesterday. Definitely catching the sellers by surprise. They must have understandably thought they had it all their own way in the second half of September. Continues to decline. You had, again, death cross here right at the end of September, but the price then came surging back because, fortunately to say it, but conflicts do tend to boost the price of gold, at least in the short term. And that's exactly what you had. You had the weaker dollar as well. And then Friday Friday's session saw it go bananas, essentially, for want of a better word, back above the 200-day moving average, closing above it or dropping back, unsurprisingly, perhaps today. But crucially, talking about trendline resistance again, we broke through it on Friday, and then we dropped back towards it on Monday, and indeed so far today, but have held above it. So that's an interesting sign. We want to look at it. If we're looking at technical analysis as the process, then that's what the market is telling us. That for the moment, if we look back into September, it couldn't stay above trendline resistance. Now it can't stay below it. So it could be a change from resistance to support for this line. And then we'll see whether it can push on above 1930. And maybe the bulls can yet save this one, because it certainly was looking very gloomy for gold last week. And it was only that price action on Friday that really changed things. It's a classic case of the price just changing our view of what we think will happen next. And that's what we do with charts. They tell us more or less the way to think or the way to view things, really. They don't tell us what's coming next, but they tell us the broader view to take on this. And the fact that gold had such a strong day, it was the best week for gold since March. But the fact that gold had such a strong day really did change the view here, and certainly buyers were back in control. We often use that phrase, but that definitely was the case on Friday. Similarly with oil prices, and again, after such a huge move in one day, it's normal to see some kind of consolidation, small pullback, but we're holding above the 50-day moving average, which continues to give us the bullish sign. Again, the way I would look at it is say, okay, we're now seeing the price back above the 200-day, we're back above the 50-day, the 50-day has crossed above, the 100-day has crossed above. This is now more looking more like an uptrend than a downtrend, which is what we had all the way through most of the summer of last year, and indeed the beginning of this year. Was that rally during July and August that really started to change the picture. And the fact that the buyers have come in to create this higher low around the 83.75 mark for Brent, and the big surge on Friday really gives the bullish view the preeminence once again, I think. So wouldn't be surprised to see it move back above 90, and then in due course start to target 95 and maybe move on from there and create a higher high within this uptrend. But we're seeing exactly what you'd expect to see in an uptrend, namely a rally, brief pullback that establishes a higher low, and move to a new higher high, a swift, dramatic pullback, but one that nonetheless establishes another higher low. So that gives the buyers, again, the upper hand, as it seems, really. So that's the key thing to watch out for. So looking ahead to the rest of the day, it's Goldman Sachs earnings, Bank of America earnings, Johnson & Johnson, Lockheed Martin, United Airlines as well today. So it's going to be a very busy session. It was a solid day for the Dow yesterday, up 300 points, just edging back towards 34,000, missing it by about 16 points, expecting it to start the day slightly lower. I think we're 33,922, so down about 60 points from where we were yesterday. But as I say, still looking very, very solid. Other US indices like the S&P 500 and the Nasdaq also trimming some of yesterday's gains. And undoubtedly those earnings today and indeed tomorrow, get Netflix and Tesla tomorrow, so it's a very busy time, but those will determine the tone of US markets, at least in the initial hours of trading. But that's it for me. Thank you for joining us, and we will see you again tomorrow at 10:30.